Have you ever wondered when the perfect moment to build lasting wealth might be? The answer could be right now, and this insight could completely shift how you think about investing for the future. Warren Buffett said, "Interest rates are like gravity. They pull on the value of assets just like gravity pulls on everything else." Now, imagine if we could reduce gravity's pull by 80%. I might be winning medals in the Olympics with jumps that defy belief. That's the kind of impact interest rates have on the value of investments, and knowing when to take action could be your ticket to long-term success. Let's take a journey back to the early 80s. Interest rates were sky-high, peaking at around 21.5%. At that time, it seemed like a no-brainer to put your money into treasury bills and sit back, enjoying huge returns. But here's the catch. It was exactly the wrong time to go all in on bonds. Those who were bold enough to invest in stocks instead of chasing those high treasury rates were setting themselves up for serious long-term gains. Warren Buffett, one of the most successful investors of all time, has long stressed the importance of interest rates when it comes to valuing assets like stocks and real estate. But why is this so crucial? It all comes down to U.S. Treasury bonds, which are often seen as the benchmark for safe returns. Since the U.S. dollar serves as the world's reserve currency, the returns on these bonds, referred to as the risk-free rate, play a critical role in shaping other investment opportunities. U.S. Treasuries are considered one of the safest investments on the planet because they're backed by the full faith of the U.S. government. Losing money on U.S. bonds is almost unimaginable unless the government were to default, which, let's be real, is extremely unlikely. So how do these risk-free bonds influence the decisions of investors? It's all about comparing returns. If a treasury bond is offering a 2% return, an investor might be tempted to look elsewhere for better opportunities, maybe stocks or real estate, which carry more risk but also the promise of higher returns. On the other hand, if treasury bonds are yielding, say, 12%, then it's a completely different story. Those high returns make bonds much more attractive, especially when you start comparing them to the riskier alternatives. Think about it like this. Back in 1981, treasury bonds were offering an 18% return over 10 years. If you were considering buying a rental property at that time, you'd have to be absolutely certain that the property could generate at least 18% or higher in annual returns to make it worth your while. If not, you'd be much better off putting your money into those risk-free bonds. The same logic applies to stocks. If a company's growth is expected to be minimal, investors might choose the safer, higher-yielding bonds instead. Now, I know this might sound a bit technical, but stay with me because this is where things get really interesting. Warren Buffett puts it in simple terms. In the early 80s, when long-term government bonds were yielding around 15%, companies earning 12% on equity were considered subpar investments. Why take the risk with a stock when you could lock in 15% returns with a bond? But when those same bonds are yielding just 3%, suddenly a company earning 12% looks like an amazing deal. The higher the bond yield, the less attractive other assets like stocks and real estate become. Now, fast forward to 2020, when the world was grappling with a global pandemic. To support the economy, the Federal Reserve slashed interest rates to near zero, bringing bond yields down with them. With bonds offering almost nothing in returns, investors rushed into the stock market, seeking better opportunities. But as inflation surged, the Federal Reserve began raising interest rates again. By 2023, the federal funds rate had risen to around 5%, and bond yields followed suit, rising to between 4% and 5%. This shift in bond yields has huge implications. When bonds start offering higher returns, they become much more attractive compared to riskier assets, like stocks and real estate. Investors begin to question why they should take on the additional risk of the stock market when they can earn solid returns with relatively safe investments like U.S. Treasury bonds. But here's the key takeaway. Interest rates and bond yields move in cycles. When interest rates are high, like they are now, It means we could be nearing the end of that cycle, and eventually, rates will come back down. And when they do, that's when opportunities in the stock market often become more appealing. Now's a great time to hit pause and remind you, if you're finding this content valuable, don't forget to like the video. We've got more in-depth analysis and insights to help you make smarter investment decisions, so keep watching to stay up to date. So, where does that leave us today? Well, just like in the early 80s, bonds are offering attractive returns, and stocks might seem a little riskier by comparison. But if history has taught us anything, it's that the best time to buy stocks is often when interest rates are at their peak. When rates eventually come down, those who had the foresight to buy while everyone else was focusing on bonds are often the ones who see the biggest rewards. Now, you might be wondering, what should I be doing right now? Well, the legend himself, Warren Buffett, tells us that when interest rates are high and bonds look appealing, it's actually the perfect time to start considering equities. Why? Because when interest rates fall, the value of stocks tends to rise, sometimes dramatically. Buffett emphasizes that while things like interest rates and currency fluctuations are important, they're not the be-all and end-all of getting rich over time. Instead, he focuses on what's knowable and important in the long run, like how a company operates, its competitive advantage, and the strength of its management. In fact, Buffett has 3 key criteria for picking the right companies to invest in: understanding the business, ensuring it has a strong competitive advantage or moat, and making sure it's run by a competent management team. These principles have guided Buffett's success for decades, and they're just as relevant today as they were when he first started. If you want to build real wealth, it's critical to focus on companies that you understand, that have a durable advantage, and that are managed by honest, capable leaders. These are the kinds of businesses that will thrive over the long term, regardless of what happens with interest rates. So, as interest rates remain high, remember that this could be one of the best times to consider building your wealth through carefully selected stocks. And as always, do your research, make informed decisions, and think long term. If you enjoyed this video, be sure to hit that like button and subscribe to Economic Hero, and ring the notification bell so you don't miss our next video. Thanks for watching, and we'll see you in the next one.